Ladies and gentlemen, and welcome to Data Patterns India Limited Q4 FY23 earnings conference call hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Samadrita from Go India Advisors. Thank you, and over to you, ma'am.
Thank you, Aman. Good morning, everyone, and welcome to Data Patterns India Limited earnings call to discuss Q4 and FY23 results. We have on the call with us Mr. Rangarajan, Chairman and Managing Director, Ms. Rekha Murthy Rangarajan, Whole-Time Director, Mr. Venkat Subramanian, Chief Financial Officer. I must remind you that the discussion on today's call may include certain forward-looking statements and must be viewed in conjunction with the risk that company may face. A small request to the participants, please restrict your questions to 1 or 2 as Mr. Rangarajan is taking the call from abroad, and given his other business commitments, we have to restrict this call to strictly an hour. I will now hand over to Mr. Rangarajan. Over to you, sir.
Good morning, ladies and gentlemen. Thank you for joining us today for the FY23 results call. I assume you had the chance to review the results presentation, which is made available on the exchanges and our website. Before we enter into the financial results, I'd like to provide a brief overview of some strategic updates and key highlights for this year. It gives me great pleasure to share that the company has exceeded its initial 25 to 30% revenue growth guidance, achieving a 46% growth for the year. PAT for the year had a growth of 32% year-on-year. As explained in the press release, my focus in the last few years has been to smoothing the revenue profile over the quarters rather than rely on the big 4 quarter. Q4 as a percentage of annual revenue has come down from 70% in FY21 to 41% in FY23. Predicting quarterly revenue and gross margins are becoming very challenging due to customer inspection timelines and product mix issues. Therefore, I would like you all to assess the progress of the company on an annual basis. Gross margin of Data Patterns' own products will continue to be robust in the region of 65%. This overall gross margins may be lower than I'm integrating borrowed items, but this will drive more growth in revenue. Considering the volatility in top line and the growth due to these factors, the right metric to evaluate the company is PAT growth. I'm confident that we'll continue to grow PAT at 30% for the next several years. As you know, we are in an investment phase and will continue to invest in people, technology, and infrastructure. I don't want to calibrate these investments based on quarterly results. Hold me accountable on an annual basis on the key metrics. Having said that, to give you some visibility on FY24, we expect the EBITDA margin to be around 30%. FY23 has been a momentous year for the company on the order booking front, with order inflows for the year crossing 900 crore mark, up more than 3x from the last year. As of March 31, 2023, the order book stood at 924 crore, up almost 2x compared to the last year. With the inclusion of these orders finalized in April and May so far, our current order book is in excess of 1,000 crores. In FY23, we secured several significant contracts, including radar orders valued at 449 crores from DRDO, Bharat Electronics, and Department of Space, encompassing both development and production. Electronic warfare development order worth 43 crores from DRDO. Production orders at BrahMos for rupees 40 crores. I anticipate a significant order booking in FY24, and most of that will be from Data Patterns' own products with single vendor tenders. CFO will give you some color on working capital movements, particularly after the March closing. Even based on our reported March 31st financials, the cash conversion cycle, net of advances, has improved during FY23 to 275 days from 286 days at the end of FY22. The whole management team focused on the key metric and committed to continuously improving it. Needless to say, maintaining robust ROCE and ROE metrics will be our focus. Even for FY23, excluding the impact of QIP funds received in March, the company's ROC has remained strong at 22%. We expect our sustainable return metrics to be above 20% as we complete the product development investments. As you know, we raised equity through QIP to take advantage of the significant opportunities presented to us. I'm thankful that investors have entrusted me with 500 crore. The management team is fully focused on building next generation products that will help scale the grade. The proceeds for this new investment will be utilized for the development of new products in the areas of radars, electronic warfare, communications, and satellites. Initially, these products will be introduced in the domestic market and will subsequently be expanded to export markets. We anticipate these products to be a significant growth driver in the company over the next 3 to 4 years. I'll be sharing more details on the progress over time. At this point, I'll pass the floor to Venkat for his comments.
Thank you, sir. Good morning, ladies and gentlemen. We are delighted to report an outstanding performance in FY23. Let me provide an overview of FY23 financial results. FY23 revenues witnessed a year-on-year increase of 46%. Development contracts accounted for 41% of Q4 FY23 revenue, compared to 37% in Q4 of FY22. Production contracts made up approximately 57% and service contracts approximately 2% of Q4 FY23 revenue. Gross margins for FY23 were at 62%. PAT for the year increased by 32% to reach 124 crore, driven by a strong growth in revenue. The commissioning of our new infrastructure took place in Q4 FY23. We have invested around 45 crore in this new facility. Despite an increase in debtor days, the overall working capital cycle has remained stable due to substantial advance received from the ongoing projects. Even on the receivables front, April collections have significantly improved the cycle, which tends to be higher at the year end. Around 25% of year-end receivables have already been collected. Receivable days stands at 241 after accounting for funds collected in April and May. Notably, a large portion of the receivables as at March end, more than 100 crore, is attributable to the Precision Approach Radar project, of which a significant amount has already been collected in April. As of March 31, 2023, the company holds over 650 crore in cash and cash equivalents. We aim to maintain a robust balance sheet going forward as well without any net debt and aim to gradually improve our working capital days. Overall, FY23 demonstrated impressive performance, achieving record revenue, strong profitability and robust balance sheet. We will now proceed with the question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit their question to 2 per participant. If time permits, you may join the queue for any follow-ups. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may press star and 1. The first question is from the line of Jehan Bada from Nirmal Bang. Please go ahead.
Good morning, sir. Sir, I have 2 questions. First one is on the raw material side. Q4 raw material cost to sales has been high. So what was exactly the reason? And for FY24, should we look at the 9 months as an indicator or Q4?
See, as I've always been mentioning, the raw material cost to sale price varies with project to project and product to product. So that is why we are told this year. Last year we were on 62% material cost, 8% material cost in sales. This will vary from contract to contract. However, we're given a guidance that typically we do about 68% of gross margin on an overall project, and these are all based on the products developed by us or data partners products. If you have to buy and integrate, then obviously the raw material cost becomes as a percentage more in the selling price. But I think this increases guidance of 68%, around 68% on an overall year rather than quarter to quarter, because what we deliver each quarter varies with the kind of products.
Right. Fine. Okay. And sir, second question, if I look at the presentation, the order book mix has shifted in favor of development contracts from last year 25%. This year it is at 64% mix. So will that impact the margins going forward?
Okay. See, margins are not really determined by development or production. Margins, it depends on kind of development contracts we get. If it is more on data products without integration, and the margin remains the same. But in case integration happens, then the margin comes down. So it really doesn't do anything with development or production. What really happens in development is there is an overhead in terms of development cost and development expenses incurred over on top of the component cost or material cost. In production, since it's a repeat of the earlier delivered production developed contracts, our overhead allocation in terms of product manufacturing is going to be only there and not development cost is not there, as we tend to write off the development cost as part of revenue expenses of that year. So that is typically what happens. Okay. Now, giving you more clarity is, see, we are a very engineering-driven company. We are more than 500 odd engineers working with us. We tend to build that engineering capability, build more products. So one way of looking at it is more the development contracts. It also gives me a future production contract possibility, which will scale the business. So a healthy mix of development and production is good. Last year, we got a lot of tender contracts on DRDO and development contracts has come. These are all very strategic contracts. We expect that these contracts will scale the business pretty well.
Thank you. Mr. Bada, request you to join the queue for any follow-ups. The next question is from the line of Akshay Kothari from Envision Capital. Please go ahead.
Yeah, thanks for the opportunity and congratulations on a good top line growth, sir. So just wanted to know, you have mentioned that you are going to increase the headcount of engineers by 100 more. So how do we plan to maintain that 40% EBITDA margin range? Because we missed it this time as well. So.
We're looking at multiple brands scaling the company because the market size is very large. So in order to scale the company, you must build products to scale the company. You cannot say, I will have few products, and that will. This is not a business model where same product gets procured multiple times. The minimum programs and projects, we need to adjust the products. India is traditionally used to importing major part of our defense equipment is imported. Our idea is to try to build those products which are being imported. See that this can be ordered in India. And if you do that with Indian technology, then the EBITDA and the gross margins and the bottom lines, what we're looking at, will maintain. So, increasing headcount per se, if you say increase headcount and the revenue becomes same, then the EBITDA goes down. But the revenue also goes up. I don't think we'll have a problem. Matter of fact, this is a very important thing that we increase capability and competence to build more products to scale our revenue. And anyway, we're given a guidance that this will be around 40% this year. Based on contracts and what we expect to deliver this year.
Thanks a lot. And all the best.
Thank you. Any participants would like to ask a question at this time, then may please press star and 1. The next question is from the line of Aditya Makharia from HDFC Securities. Please go ahead.
Yes, sir. Hi. Just wanted a sense on the competitive landscape. So is there any way you can define your market share or maybe, if not exact numbers, but what's your share of business, for the particular
Sorry, Aditya, your voice is breaking. Can I request you to come in network?
Yeah, hi. Is it better now?
Much better.
Yeah. So I wanted in terms of market share which you have in the business you operate. You may exact numbers, but just direct.
Sorry, Aditya, again your voice is breaking. I'm sorry. Request you to come in the network area, please.
I understood Aditya's question. Let me answer if that is the question on competitive landscape and market share. See, the size of business is very, very large, and the business we are addressing is much, much smaller, giving the enormous scope for growth. Having said that, if you look at competitive landscape, then the entire products are actually imported. Very few things are being done here. On the product end, the landscape, the competitive landscape is only foreigners. We are trying to address that market and try to enhance our products into this. But if you look at what we deliver on the Indian context, with Indian competition, we are very well placed in the areas of radar, in the area of electronic warfare, and so these are areas where the company has deep competencies. So on a technical competency, we are far, far higher than others. But we can't talk about market share per se because that varies contract to contract, vary, and depending on individual capabilities. A lot of people tie up with foreign companies and they make the product available here. We typically tend to develop products here, and that is why the EBITDA and the gross margins are higher. So the idea is to try to enhance our market by building more products, is what we are trying to do. And these products will be developed on the development contracts, they will repeat business to scale the business. But we've also done QIP, 500 crore money we got in. We're essentially going to be into product development into various areas where we'll try to bring in leadership in this area, which can scale the company multi-fold.
Okay, got it. Thank you.
Okay. Yeah.
Thank you. The next question is from the line of Jonas Bhutta from Birla Mutual Fund. Please go ahead.
Hi, Ranga sir. How are you?
Fine. Jonas.
Hi. So just two quick questions. Firstly, can you talk about the two orders that we got from DRDO worth about 130 odd crores? One, the radar, the 83 crores, and the EW 53 crores. What are the projects and whether we are the lead here or we are supposed to, after this development project, this will ultimately go to one of the PSUs where we'll again be a subcomponent supplier. If you can talk about that first.
Your voice is not very clear, but I'm assuming this is a question. You want us to talk about two orders from DRDO, one on radar, other on EW. Am I correct?
Yes, sir. The 83 and the 53 crore. Yeah.
Okay. So this is a couple of contracts we received from DRDO. This is for requirement for upgradation of radars and electronic warfare system for a naval application. We expect to deliver this contract this year, and requirements are more than 20 to 30 aircraft to be upgraded. If this is successful, then we should place an order on HAL for further upgrade. So this is an important order for us. It will give us revenue visibility in the next 2 to 3 years.
Understood.
And already we are on the job, so we should be able to finish the contract on time. And it will be equal to any international product in this range.
And so sorry, I missed out in the opening remarks a bit. So did you give a guidance on what kind of order inflows you expect for FY24? Because I assume that the Himshakti order and a couple of Rudra orders would sort of flow in. So what are the total orders that we're expecting for F24?
I didn't mention a particular number, except that we are expecting sizable order inflows this year. This because we don't want to talk about the specific contract. You are aware of Himshakti and all the orders which we talked last year. Bharat Electronics will release the orders. Back to back, inquiries have to flow in, and we should be able to get those contracts. But we expect the order book to be sizable like last year. This year also, we expect that maybe more than 600 crores contracts. We are not very sure exactly what timing those contracts will come. And one difference between last year and this year is we expect a number of data products orders to come in. As against integration contracts we taken up last year, this will also have mostly data products. On top of it, we are also participating in tenders, and if we are successful, hopefully we'll have a repeat year like last year on terms of contracts. But I think it's up to third basis 57 crores of data products.
Understood. Sir, the last question was around net working capital. If Venkat can give us the latest numbers on the margin money, because I think about 116 or 120 odd crores was sitting as part of other current assets last year. What is the number for the current year as in FY23? What is the number of the margin money? And we see that the advances have gone up as we've received orders. So what is the rupees crore value of advances sitting in our balance sheet today?
The margin money as on date with the banks is around 80 odd crore in March. This is actually basically for the bank guarantee limits that we enjoy and a couple of LCs that we had to open. And this is expected to come down a bit because some of the margin money kept in March is with 100% cash margin. Some of the guarantees have been taken with 100% cash margin. Those will get accommodated in the enhanced limits that we have already requested, and it's in that process. Once that is done, then 100% will be removed and only the margin requirement per bank will be there. And as regards to advance, we have more than about 170 crore of advance sitting in the balance sheet, which includes advance received from a couple of development contracts in the last year.
Understood. And what is the value of unexecuted order book of these developmental projects that we won last year, about 400 odd crores that we won in the two radar projects? So what is the unexecuted part?
What is it? Your voice is breaking.
What is the unexecuted part of the two developmental projects that we won earlier this year, the DRDO radar orders?
The two DRDO radar orders have not been delivered at all. It is for FY25 only.
Thank you. Mr. Gupta, I request you to join the queue for any follow-ups. Thank you. The next question is from the line of Dipen Vakil from InCred Equities. Please go ahead.
Thank you for the opportunity, sir. I just wanted to understand a little bit more on the order book side. So can you help me with the execution schedule as to how we plan to execute on the almost 1,000 crore orders that we 1,000 crore orders that we have currently? So will it be executed in 1.5 year or 2 years? As to how do we factor in?
I think about 50% of the orders on hand will get executed this year, this 23-24, FY24. The other 50% will get executed next year, barring another 30-40 crores. Most of it will get executed in FY25.
Okay, that's helpful. And any competitive scenario going ahead as to what major orders can we expect in FY24 for us to win?
Yeah, we are expecting a sizable order intake in FY24 due to number of contracts we earlier delivered products. Those have all back-to-back contracts have happened with the public sector, BEL and HAL. So we back-to-back expect those contracts to happen. Probably in the next 2-3 quarters, we expect the contracts to come in. And most of them will get executed next year or the year after next. But a little portion of the contracts we're getting may be executed this year itself. But we do expect the sizable order intake this year.
Okay. Then that was all my question. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Aman Vij from Astute Investment Management. Please go ahead.
Yeah, sir. My first question is on, so we had bid for a radar for active protection system few months back. So if you can please the addressable market size of that product, and also when is the results expected of the tender?
Yeah, I'm not getting. Which is the active protection system you're talking about? That will be
Radar for active protection system for MBT.
For MBT?
For the tanks, yeah, tanks, MBTs and all those.
No, that we have not got any order for radar for active protection system or NBT. We've got a automatic weapon loader. That is a contract we got, which will get executed next year. I'm not really aware of how the contract will get into numbers as we go along. We don't have clear idea of predicting every development order, where it will go into production and when it will happen. So that is why we don't project all this properly. And we project or take projections of contracts which will be exceedingly clear that this is going to happen, give or take a few months or a year or so. But this is in development stage. We have received the order in this last quarter. So that is not a radar actually. It's more an electromechanical system, an electronic system.
Yeah. Sorry. The question was, sir, we had bid for that program, right? The development for radar of active protection system. So is the tender out and we have not won, or the tender is not out?
No, we keep quoting many tenders.
Mm-hmm.
That's why tender business we don't project at all to market. Because there's a 0-1 possibility, if they either win or loss. So we never talk, when we talk about the next year projection or order intake, I never talk about tenders. Tenders, if it happens, it's plus. Otherwise, we don't really worry about it. We're more worried about our own products. And all of this is not the predictable radar. We really cannot predict the development time frame and the repeat requirements. It's not a really predictable. Those kind of contracts are not very predictable.
Thank you. Mr. Vish, request to join the queue for any follow-up. Before we take the next question, I'd like to remind the participants to limit their question to 2 per participant. If time permits, you may join the queue for any follow-up. The next question is from the line of Harshit Kapadia from Elara Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity, sir, and congrats for the very good FY23 you had, meeting all the estimates here. Second, sir, a few questions from my side. And now, at the start of the call, you mentioned your developmental order share was higher as far as revenue is concerned. Is it related to what product segment within developmental orders where we have seen a higher material cost for this quarter?
We participated in a couple of contracts for DRDO, where this is unlike our product, which we normally quote, where a lot of competitive bids. We call it a competitive bid. Again, these development bids, development contracts, hoping that we'll get additional contracts. This is on a radar level. And those had a more material cost than the overall selling price. That is the last quarter. That is what you're asking. I didn't really understand the question. If that is a question, this is a couple of radar subsystems which we developed. And that is the one maybe you are referring to. Last year order book, there are again development contracts, large development contracts, entering a course from DRDO on competitive bids. So these are 2 areas where we have bid them competitively.
Fair enough, sir. And
I just answer the question.
Yeah, sir. So you had recently launched a checkout missile system for BrahMos. Would you be able to share, this is an additional product which you have developed. So what would be the size in the overall BrahMos, missiles, or if you get an order, what would be the enhanced value for you, if you can share something? And is it used for all the 3 armed forces, or is it only for Air Force and Army who will be getting the orders, and Navy is not part of the profile? Can you share some insight on that?
The checkout equipment is used for all services, Navy, Army, and Air Force. We developed it way back, more than a decade back. So we cannot remember the exact date. Only the product is developed. And subsequent to that, Army, Navy, and Air Force have been buying this, along with further contingent missiles. When you buy more missiles, they also have depot-level test systems. They also buy that. Back to back, we get the contract. So we've got some contracts executing this year. This year also some are going to execute. We're expecting more such contracts for a naval order, which is getting finalized on BrahMos. So back to back, we should get some contracts this year or probably early next year.
And any size you can highlight?
All services are using.
Any size?
These are programs and these are projects, so it varies with the project size whenever it comes. So it all adds to 30, 40, 50 crores kind of business once in a few years we get.
Okay.
Yeah.
And lastly, related to BrahMos, you were developing a seeker for the BrahMos site, and I think it was under final testing. Any update on that? Have we received that clearances, or we are still in the testing mode? That would be helpful.
We have done some air trials. Now the missile trial is supposed to be done probably in another 2-3 months. Once we finish it, we'll be able to tell you.
Fair enough, sir. And all the best for the future, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Congratulations, sir, on a strong performance for the year FY23. I just want to understand, usually quarter 4 for us is a very strong quarter in terms of revenue booking, and with that comes the operating leverage kicking in for the company, and that has been consistent for the last 2 quarter 4, as in 21 and 22. So I just want to understand, on the margin profile side, why have we seen a lower margin, compared to earlier Q4s, and mainly because of employee benefits and other expenses? Just I wanted to understand, is there any one-off on the expense side for this quarter?
The first part, let me answer. Second part, maybe Venkat can answer. Traditionally, this company has been in developing mode with DRDO and Department of Space. And, we developed the product for the year and try to deliver before March, because there is also March fund release, etc. from the customer side. So almost all the products are developed, and we find we take 8 years back, 10 years back and all that. We'll find that very high 80-85% will be in the last quarter. That is how the revenue was. And we've been thinking about how to even out the cash flows, if is necessary, and not take it everything to the last quarter. And actually went public. This is one of the very important things we set ourselves, because before going to IPO, we started getting visibility on year and a few year visibility. And then we want to scale the business. So one important aspect is to even out the cash flows, ensure that the last quarter is not really the major quarter. No, it will be still higher. It should not be so high as 70% and 60%. So we have successfully brought the quarter-on-quarter, moderated the quarters brought the quarter last quarter from 70% to 46%, 49%. And this year also, we expect to bring the last quarter turnover to below that, where the cash flow gets even down. So this is the right thing to do, and we're doing this in a very difficult government business. We're trying to see how do we make the quarter's performance better. The next part on the margin profile, I don't know what, I couldn't understand the question. Venkat, did you understand? Can you answer this question?
Yeah. Hi, Vignesh. Actually, Q4, we've had some specifics because we've announced salary increment for all our employees effective from November of 2022. Plus, towards year end, when we do an actuarial valuation for gratuity and leave encashment provisioning and other things, because last year we had a lesser attrition will lead to higher provisioning for gratuity and other things. So these things have contributed some substantial increase in our employee costs quarter-on-quarter basis. This is the main reason for reduction in Q4 margin. But of course, on the gross margin level also for Q4, it's a couple of contracts where the material cost was higher than our normal material cost level. The gross margin was less, and additionally the employee cost has contributed to the reduction in the EBITDA margin.
Thank you. Mr. Iyer, request you to join the queue for any follow-ups. Also, ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to one per participant. If time permits, you may join the queue for any follow-up. Thank you. The next question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Thank you very much to give me opportunity. Sir, you mentioned large order value tenders with the Ministry of Defence under first and second category. Can you tell what is the value of tenders?
So that varies a few hundred crores to a few thousand crores. And make one, of course, value will be lesser. Initially start with the value of the contracts will be lesser, but these will get into a large requirement as we go now. Once you do a make one or a make two, the development contract size may be 20, 30 crores, 100 crores, or 200 crores. But the requirement, why this is done as make one, make two, is because the requirement is very large. And it is best that we do it in India. So design contracts, this is called MODs to design contracts. This is not contracts which is like a buy, more a development contracts. That is what the make one, make two has. So entry into this contract is successful, then it gives you a hold on very large contracts with you now.
Thank you. The next question is from Garvit Goyal from Invest Research. Please go ahead.
Hello. Good morning, sir. Sir, despite showing a tremendous earnings growth, our operating cash flows turned negative this time due to rising trade receivables. So my question is, at one place we have included a slide in our presentation mentioning about well-managed working capital. Then why the same is not getting reflected in our cash flows, sir? And how we look to manage our cash flows going forward, as earnings growth without cash flows is a matter of concern for sure.
Thank you. You want to answer?
Yeah. See, our cash flow, operating cash flow is negative because substantial, increase in the current assets this year at the end of March. At the opening remark, I have made a specific mention about reduction in our receivable days. Post-collection happened in April and May. We got substantial collections of more than 25% of March receivable in April. One contract contributed to more than 100 crore of receivable. Actually, that got delayed, and we have got substantial portion of that in April. So netting off that, if you see the operating cash flow would have been in plus only.
Going ahead, I think this is an aberration for this year because of the amendment for the contract which we wanted has taken a lot of time because the company is going from private limited to limited company, and the contract had to get amended. The amendment is taken enormous time, so the execution is happening. The contract amendment could not happen because it has to go to the different ministry amount. So that has taken a lot of time, and therefore which the cash flow, the collection cycle became bad. But that is rectified now, and we're going ahead. So this is an aberration here. I don't think that should be considered. And going ahead, I think our cash flow cycle will be far, far better. And as we say in the opening remark also, we are aware of this, and every effort that we put to see that it is brought down, and the number of debtor days is substantially brought down going ahead.
Thank you. The next question is from the line of Harsh Bhatia from Bandhan MF. Please go ahead.
Yeah, thanks. Morning. Just one question from my side. So we have spoken about Arodhara and Ashwini radar opportunities overall from a 2-3 year perspective. Any particular sense on the Uttam radars for Mech 1, Mech 2, Su-30 and AMCA? Like, are we looking at that opportunity as a segment? Because from what we can understand is that you are one of the few players who can manufacture the Uttam radar. So anything you're looking at from that perspective, and what is the competitive landscape for that particular project or segment? Thanks.
Yeah, we are looking at development against Mech 1 and Mech 2 radar opportunities and EW opportunities. We are participating, very effectively participating on that. And also on the Su-30 upgrade, we would like to participate. So for all of them, we should develop products to address actual requirements. This is the reason why we've taken the QIP to see that we address the large opportunities coming us as a product made completely designed by us, other than buy essential parts or IP from foreign vendors and integrate it in India. We would like to make the IP here. That is the reason why we took the money. And we're very, very aware of the opportunities, and we are trying to address these opportunities presently. I can't give you exact, size of business, etc. now, because we won't be able to predict the outcome. We can only try and say what is the competitive landscape and how we will be able to address the landscape with Indian products. We are doing that. I think this is the only way to go to scale the company to multifold. Unless you look at MOD opportunities and become equal to an international vendor, compete with them and build the products. That's the only way to scale this business. So that's the reason we have taken the money.
Thank you. The next question is from the line of Manan Polaria from MKP Securities. Please go ahead.
Hi, sir. Am I audible?
Yes.
Yeah. So my question was, we've seen the developmental order share of the order book go up, and we just what I want to understand is, if you're executing the developmental orders, what would be the time frame to execute them, and by time frame would they turn production orders?
See, I can't talk about time frame. Yeah, again, this varies. The time frame of development contracts can be less than a year or can be 2 to 3 years. It's kind of scale depending on the size of contract and complexity of the development contract. But the repeat time frame is not very predictable. That is why we don't predict repeat time frame when it will happen. It just gives you a potential business, but that is depending on so many other aspects of that particular contract. So we expect the next few years the repeat business will happen. But that is why we are looking at how to get the business, what products is predictable, and that is what the management is really doing today. We how to scale the growth and new revenue product. But around 1 to 3 years is the development time frame.
Thank you. Next question is from the line of Abhishek Agarwal from Naredi Investments. Please go ahead.
Good morning, sir. Thanks for giving me the opportunity. Sir, my question, you are targeting to order of 2,000 crore to 3,000 crore. Is it on track? And any big order likely in the current year? And how much order are you expecting in FY24?
No, I didn't get the question. You said 2,000, 3,000 crore. You want to know what is the order expected of the intake in FY24, right?
Yeah.
I think it's upwards of 700 crores. Exact number I'm not able to tell you. But we're looking at a large portion of this year's order intake will be data patterns products, whatever we delivered earlier. So these contracts back-to-back has come to public sector. We expect a back-to-back business for all of them. So upwards of 700 crores is what I'm thinking. And as we go along, the data will be more clear as we go along in the first 2 quarters. We're also participating in a number of tenders to see whether we can, the order intake can be higher than last year. We're working on it.
Thank you. The next question is from Gagan Thareja from ASK. Please go ahead.
Hello. Am I audible?
It's a bit low, sir. Can I request you to speak up a bit and come closer to the mic?
Is this better?
Yes. Please go ahead.
Yeah. Good morning. Sir, 2 questions from my side. One is on the work that you intend to do on the satellite side. I think you indicated that's a sizable addition to your opportunities going ahead. So if you could give us, your view of what could be the contribution from the satellite market for your revenues and profits from a 3 to 5 year time frame. And second is, has the board finalized on a succession plan? And if so, what are the contours of that plan?
Okay. Yes, we are putting a lot of investment in the satellite. We have launched our own satellites. They are all nano satellites, fully designed by us, launched and working successfully. Only these satellites are built with different satellites and other satellites in mind. So we built everything redundant. So there is no single point failure. And everything, including ground stations, receivers, all the software, everything is designed, hardware has been designed by us. Simply get ahead. We are trying to make serious class satellites of 100 200 kg class, lower Earth orbit satellites now, including payload, for both for optical imaging as well as radar imaging. We are developing products ourselves. And quickly we are starting the design that is being already initiated. We expect that maybe we should get some development contracts as we start the development cycle itself. We expect something to happen, but that is not to be clearly, we can't say that clearly now, but we are on the job. And these will be world-class satellites, completely meeting our defense requirements. We have all the specifications that we require. We are trying to meet all of those specifications in our design. So once this is developed, not only India, where multiple numbers of these satellites are required for surveillance purposes, but these are required across the world. So as we're building world-class satellites, we expect that once the few satellites are launched in India, the same can be available outside. So we would help. One of the products we want to help the data patterns scale. This will be one of those products. But exactly the size of revenue and business at this present point, I'm not able to tell you. But what we can tell you is the size is very large, and India has a competency model, and we in data patterns has all the knowledge to build this, and we worked for 8 years on development of satellites in all parts of it. We're trying to see what we can do to cause the satellite. See, then we look at the business model. But in the meantime, we'll start marketing this product also. As for the board succession plan, yes, that is on the cards, and that has been discussed in the board meeting. We also, last year, Vijay has been inducted into the board. He is the CEO of the company, and he is just more than 20 odd years. Inducted into the board, see that he can also understand board operation and company review. Also, we are trying to build a top management structure. We are trying to recruit people outside. There's a lot of activity to see that the organization build is happening. And the board and all of us are working on that to see how we can strengthen the organization moving ahead. Because the opportunities in front of us is very, very, very huge. So we are understanding seizing the opportunities in Africa. Right. There's the people and the position. Yeah.
If I'm permitted, I have one more question. Can I go ahead?
Yes, please. Go ahead.
Yeah. Sir, I think over a period of time, you indicated, the share of integrated projects will inevitably rise as you intend to go after larger scale projects. That being the case, what should one think of as sustainable in terms of margins and working capital for you? If one sort of presumes that that is the direction in which the quality of revenues will move.
Okay, see, just because we say we are scaling, it doesn't have to necessarily come out of integrated projects. Okay, we can build the radars, and the radar can go into aircrafts, and the aircraft radars can do 20, 30 radars every year. If we keep doing that now, that also can scale. Similarly, RWS can scale. The avionics, SDRs can scale. The quantities can come from the same avionics or electronic systems we design. That is also scale. The satellite market can scale where the bought out may not be as large. Some are bought out there. But those two necessarily scaling does not mean it has to be only integrated programs. What I did mention is, in the event of integration products come into picture, there is the margins, obviously gross margin will be lesser. So that is what we mentioned. But it's not that scaling will happen only with integrated projects. I don't think that is necessarily true. Yes, in certain MOD tenders, when trucks are to be bought together to integrate, you need to buy the trucks, the EPS, the generators, and a lot of other systems which is a bottom. So we need to take this together. But it's very difficult to predict what will the margin be in this contract and best image the revenue for 3 years from now will be this, unless the contracts are already on hand. We're only bidding for the contracts, developing against those contracts. So we won't be able to give you an exact number on the margin profile. What is important is what I said in the opening remarks. With respect to the margin, what we are worried about is the bottom line growth, the PAT growth. We are confident that we will scale PAT more than 30% year on year in the coming years to go. And we look at contracts to help us to see the PAT margin will maintain and scale. Once we do this, answer the second question of working capital. And the PAT margins are this large, I'm sure we will organize the working capital. And we will also an element of advance which the customer gives in all these contracts. So limits, we should be able to actually carry out the problem is what we see as we go along now. I don't see any problem in the foreseeable future looking at the issues for the company. We're also generating a lot of cash. So we will be able to handle that without a problem. I can answer this question more once the contracts come in at a particular time, then we will be able to answer this question properly.
And is semiconductor chip availability a bit of an issue? Because I think some of your peers in the public sector have pointed out that it's constrained their ability to execute on schedule, and specifically in the missile projects.
We had a problem last 1.5 to 2 years. There's not a problem because predictability of the component. We place the order after 7 months or 6 months or 4 months. The component is supposed to hit our stock. And at that last moment, it will get postponed. We had issues like this. To compensate and adapt to the market, only what we've done 2 things is order ahead because of the panic in the market. So our stock holding has gone up because of this particular phenomenon. We see that our stock holding has substantially gone up in the last 1 year. To see that we hold stock and deliver and not give it a problem on non-delivery. So we've handled that possibly. Second thing we got is some of the components in power supplies where their predictable delivery model was not there. We redesigned those portions. Yes, there was a shift in delivery and we compensated the quarterly revenue with some other products which we could deliver at that time to manage the quarterly revenue. But we have come across all of those problems. Today, I think we have a fairly good hold on the component. At the present moment, we don't have great challenges which we faced 1.5 years back. So I think it's tapering down. But we are taking other decisions to stock and sell and also redesign. We're going ahead. We don't have the problem is not so imminent or looking large now.
Thank you. Mr. Pareja, I request you to join the queue for any follow-up. Also, before we take the next question, I'd like to remind our participant to limit their question to 1 per participant, please. The next question is from the line of Vivek Gautam from GS Investments. Please go ahead.
Yes, sir. Sir, my question is more on the sector side. Is the change in Ministry of Defense and DRDO for real? Because CMD used to change every 2 years earlier, and the work culture was somehow lacking due to the job security and time-bound promotion and other things. And any political risk also, sir, in this election year, and what steps are you taking to negate the risk in case of a change in the regime of Modi government? Thank you.
Your voice is really, I couldn't hear it properly.
Hello? Is it better?
Make a short question. I couldn't. Yeah,
I just wanted to know, sir, is the change in Defense Ministry of Defense DRDO for real? Because earlier, like the typical PSU, the CMD used to change every 2 years, and then the job securities of the employees and time-bound promotion. And second thing was about the political risk in the election year. If the regime changes, what steps are we taking to be prepared for it in case?
Okay. DRDO, MOD changes are not very particular. They were not recruiting people in the last few years. That has been opened up in DRDO, so they started recruitment. But I can't comment on that. But looking at a risk profile, we're looking at what is the risk. We are addressing the risk profile internally with our strategies. The second major point we talked about is a change in political scenario. In case a change in regime happens, what really happens, how our markets get affected. I think, whatever direction this government has put India in on the defense on Make in India kind of program, this can't be changed even if there is going to be a regime change. Because what has been done is the right thing. The dependency on foreigners is very, very high. And this inwards policy cannot be changed overnight. So it is going to take a lot of time. Any change happens in government slowly. So change otherwise also will happen slowly. So we are not really unduly worried about change in regime, bringing change in business practices or opportunities in India.
Thank you. The next question is from the line of Rikesh Parekh from Rockstud Capital LLP. Please go ahead.
Yeah, thanks for the opportunity. So my question is relating to the order book. So we have a large portion from the development contract. So based on our past experience, how much percentage of the development contract converts into production? And also, are the margin any difference between the development and the production contract?
It's very difficult to predict the conversion ratio from development to production. We found in the last 15 years, we were not able to predict it very well. And it used to be ups and downs in these contracts. So we used to use kind of a roller coaster kind of ride which is being said. So what we did, we took certain strategic decisions on where we participate and what kind of contracts we participate. We are not really participating in component level, PCB level systems now, where, that continuous change happens in these kind of contracts because new components come in the market 2 years down the line, they want to redesign it. So these kind of things which gives you very, very poor visibility and control of the program, we no longer participate in. We participate in contracts where a substantial sum of the percentage of the contract is designed in-house. This is where we bring in the competencies and the competitive advantage which we have. Since everything is designed by us, we have to integrate the systems. We bring in a value add here. We become competitive in terms of pricing and also in terms of time frame. We can deliver far ahead because everything is designed in-house and we make the building blocks too. So this is a strategic decision we took and that is paying off properly. In this, we are taking to only develop into main contracts, which is a high probability of conversion into production contract can happen. But still, I can only talk about high probability. From the knowing the customer, knowing the products, we try to see what we can do. And exact, say, when we develop a contract, what percentage will become production is something it's not a very clear science as of now. When you're asking the second question, in the development contracts, margins are higher, in production contracts, the margin become lesser. That's not necessarily true. During development contracts, the gross margins, whatever we have, and we absorb only, we make lesser money because we try and develop the products, the manpower and overhead costs, and the prototyping costs, the test costs. All these costs are all incurred during development stage. But what we do is we expense the development cost as part of the development revenue itself. So in that year itself, we expense out, we don't create it to overheads. So the production cost happens when those additional costs which we incur are not repeated. So our gross margin remains same. So unless otherwise the volumes are large and different negotiations have happened and the requirements have changed. But normally I would say that the gross margin remains same. And as the year goes ahead, we also compensate for the foreign exchange rate change, etc., overhead change, increase. All these also compensated and priced accordingly. It's always good to have a ratio of development and production in the business which we have.
Thank you. Ladies and gentlemen, due to time constraints, that would be our last question for today. I would now like to hand the conference over to Mr. Rangaraj closing remarks. Thank you, and over to you, sir.
Okay, thank you very much for participating in this call. I can only say that we are very excited about the future. The size of business is exceedingly large. We have built a company with a whole lot of product competencies and capabilities. A very high share of engineering engineering graduates in our company. We expect to build IP and competencies going ahead. We've taken pilot course at QFE money to see that we build products which can scale the company multifold as we're going ahead. We have a sizable order book. We have a sizable visibility of orders going ahead from here. So I think we are on the right path, and we can build a substantial kind of business here. The opportunities are very, very large. And Made in India is there to stay. And unlike others who are trying to build and collaborate in Make in India, we're trying to address the opportunities by building products in India, which will give us a better bottom line, better EBITDA, and much better scalability going ahead. So any further questions, you also write to us, and we will answer those questions. We will go to India, so we will be able to answer all the questions. Thank you for taking this call. Thank you very much.
Thank you very much. Ladies and gentlemen, on behalf of the advisors, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.